Greetings, friends, and welcome to the Financial Games Special Edition. As always, Jose Miguel Suerpi and Ferdinand Ronyo here with you. This episode, as you know, is strictly about the economic side. The second episode will be about real estate. Let's get started and dive into the news in detail.
Ferdinand, with you, I'm here once again recording episodes. It's already July, halfway through the year, and a lot of events are happening. Also on the podcast side and news, well, we're going to have guests soon on our podcast.
We'll have them.
We're working on that.
Right.
We already have at least 3 special guests we want to bring on. One of them invited us to his podcast, Beyond the Element, Giancarlo Cruz. I encourage you to follow him as well. Look him up on YouTube. So he's going to be with us on Financial Games Special Edition. Roberto's coming back. He's going to be recording with us here in Miami. And soon we're going to have Mari, Olia Ruano as well.
We're planning to do that one in Cape Coral in one of the houses, and we're going to set up in the model home that we already have ready. So yes, we're going to do it in the house. Barrio?
The fourth market session is a very significant week filled with plenty of news updates. For next week, after today, when we're recording, comes the Fed and the Federal Reserve meeting with a decision on rates on July 29th. Starting with that, well, I have a pretty relevant and important fact. The Fed is meeting. For now, by the way, the majority favors that in July, there shouldn't be either a hike or a cut. We should stay where we are. Something interesting, since in June we had the ceasefire and the agreement over there, oil dropped significantly during the month of June. So we saw certain inflation metrics improve. The CPI for the month of June, it decreased month over month, and on a yearly basis, there wasn't an increase as expected. We had positive inflation data. I had mentioned a bit personally in the previous episode that energy is pretty much controlling inflation expectations right now. Depending on what happens with energy, what happens with oil, we either see inflationary pressure or we see some relief in inflationary pressure. And that wasn't the case in June. We stopped seeing relief, and then in July, when we started again, agreements were broken, there was violence, attacks resumed, and what happened? Well, oil prices have shot up again so far in July. Yesterday, the price per barrel crossed $100 again. Gasoline prices have risen drastically, and so this is creating inflationary pressures again.
Yes.
This creates pressure, but the Reserve meets on the 29th, makes an important decision, and on July 31st, data comes out about the PCE, one of the Reserve's preferred indicators. So the latest PCE we have is data from May. The June data comes out on July 31st, so they supposedly won't have that data. And they also don't have the GDP for the second quarter. So they say that next week the Reserve is kind of running blind or with a bit of outdated data. So, what do you think, Ferdinand? Should we maybe focus a bit more on the September meeting?
Well, personally, I think there will be a rate hike before the end of the year. I think oil at $100 trickles down into a lot of things. Trickle down means it filters into food prices, mainly into consumption and also into consumer staples. I think that you have the element of the elections, you have an element of change. Historically, I did some research on what happens to the markets before November in a midterm election year. Typically, there can be a correction, usually due to the anxiety of possible changes. August can be a tough month, and that movement might be even more pronounced because we're already seeing in the futures market an 82% chance that the Fed funds rate will go up by at least a quarter point. And so the Fed starts to take some measures in general terms. I see. Already in the tech sector, I see some small cracks from overvaluations and inflated expectations that I don't think will be met. If we look at Microsoft, if we look at IBM, they're starting to talk a bit about how things are beginning to get saturated. And typically, if we look back at history, Year 2000, 2001. Well, let's take out 2001 because that was September 11th, a black swan event. But in 2000, when the tech market, specifically the internet, was inflated, it wasn't the same market. I make the same comparison as with real estate. This isn't 2008. What we went through was a correction. I think there might be another correction coming, and it'll probably be a healthy one. And now the banks, today I think Chase or JP Morgan sent out a memo saying chip stocks are overvalued, but any dip will be a buy-in opportunity.
Definitely. Talking a bit about this tech concentration and the AI race, for example, the rhetoric last year in 25 was about who would win the race for AI. Which company will be the leader, the one that comes out victorious and will be the most profitable? This year, the question has been more about who's spending the most and why. Spending. That was the news, for example, with Google this week. Yesterday was post earnings day for Google, and the stock dropped almost 8%, over 7 points in a single day. One of the worst single day trading drops for Google in several years. And basically, the main reason is because they announced a huge capex focused on AI. It creates concern, it creates volatility, and people say, wow, are they going to keep spending? Are they going to keep investing in it? And to what extent? I look at it a bit from a glass half full positive perspective. As long as the company's earnings per share keep expanding and increasing, why wouldn't we spend on it? Why wouldn't we invest new capital or new capex to help the company grow? So we have to see how it all plays out, but we can already see how the market reacts, how investors react when this kind of aggressive investment in capex is announced by these companies.
Doors.
For example, there's a lot of talk about Equinix, which is one of the positions in the stress-free equity portfolio and has been an excellent performer this year. Equinix is a way for you to invest in the market, to participate in it, but not directly related to the service provider because it's a data center REIT. Once that message gets out, it starts to gain traction. And what we've really seen in the market is that this trend has expanded. And the behavior is more diversified, right? What has been the best performing index so far this year? The Russell, up about 18% so far this year, now in July. And people ask, they say, so is there a bull market in small cap? Should we invest and not go long and not? Look, with caution, because small cap companies, Ferdinand Bay, maybe you can elaborate a bit on this, they rely heavily on private financing. They're companies that are looking for liquidity and they typically have high levels of debt, and we're still in a scenario where debt is expensive, so I don't see it materializing. I don't see it as a full bull run in the Russell. In fact, I think what we've seen this year has already been extraordinary, but I don't see much more room for continued growth in the Russell. That's just my personal view, because after all, debt levels are high, and debt is still expensive. That's in terms of small cap. In terms of technology, we've seen how. It's been patchy. Of the Magnificent Seven, we have companies like Apple, which is one that's been performing relatively well so far this year, but then we've seen Google and Microsoft.
Each having their own situation. What has happened is that the market has been concentrated with 20% of the market carrying the other 80%. In the case of the Russell, typically small cap companies are less affected by geopolitical situations and international or currency changes. For example, we're seeing the Japanese selling a lot of treasury bonds, which has caused at least the 30-year bond, which is now at 5%, above 5%, something nobody saw coming more than a year ago. There's no doubt the president is now asking for 36. We're talking about a truly staggering and massive amount of financial resources, amounting to many billions of dollars, for the significant military conflict that we are now entering with Iran. The bond vigilantes are starting to get a little nervous about the levels of debt, the deficit versus production. There's some factors that I see in general in the interest rate market. The mortgage market, we'll talk about that in the next episode, but the mortgage market is very sensitive to the 10-year bond. The 10-year bond is already at 4.60, 4.65, nothing, 4.7. Typically, remember that and we're not in a bubble, even though a lot of people think we're in a bubble, but all the general market overvaluations, when you have a market where the Fed starts to adopt a slightly more hawkish policy, hawkish means a bit more restrictive. That's why you're seeing volatility that started to increase in the market 2 weeks ago, aside from the geopolitical situation. And it's partly because the Fed is the one with the ball. It's the one that puts the harpoon in a little and is the one that deflates that situation a bit. I saw a consumer report that I follow, a consumer company. We're starting to notice a retracement in spending habits, mainly among 80% of the population. Currently, 20% of the huge consumption in the United States is based on the affluent. How long can that affluent group keep up and maintain that spending with oil at $100? Oh no, I don't think it's sustainable. So there are several storm clouds gathering. It's not a reason to panic, but my question to you, to Roberto, is what risk management are you considering as you look at these clouds, having already had a successful year in terms of profit? Well,
This year has really tested the theory of highly diversified portfolios. It's been the it's been the best performers in terms of portfolios have been the ones that are well diversified, not so much the ones that have been more concentrated. For example, at the stress-free level, you know that in the max 7, 6 out of the 7 are core holdings in that portfolio, and they haven't had a very good year. So even though they're only 6 out of 20 positions, they've been a bit slower. So, in terms of risk management, I think it's about continuing with these quite diversified portfolios, with the different portfolios being well diversified. We've started campaigns with our clients to reevaluate what tolerance means. Am I properly invested?
yeah,
Have my circumstances changed? This is where psychology comes in a bit. The psychology of behavioral finance, right? In the sense that there are clients who have realized, with the volatility we've seen so far this year, that maybe they really don't have the stomach, as we say, to be 100% invested in a growth portfolio. Instead, we should be a bit more diversified. So we've gone back to that message, going through that process again of looking statistically at what your tolerances are, what your goals are, reviewing them, and digging a little deeper.
in the plan, that's very wise that they're doing that because if you look at the sentiment indicator metrics, put and call ratios, etc., I won't get into the technical details. Basically, these are indicators you use to take the pulse to see if investors are getting too confident. And typically, when the small investor is feeling very confident, guess what happens to the market? The market turns around. And when they're very pessimistic, the market turns the other way. You do the opposite of what those types of indicators suggest, and those indicators are pretty high right now. Investor sentiment out there still says we're in a honeymoon phase and that we're really headed to the moon. That's concerning, and I think that's very interesting. Remember, I always have two sayings. Investors are all investors as long as they make money. When the market starts to correct, and
We as advisors really have to take a moment to consider.
of course,
We have to be very attentive to our client's sentiment,
their temperament, yes, good.
temperament, how that client reacts in these moments. Notice, with everything that's happened, all these cross currents, all these flags that have been raised this year on a geopolitical level, locally, debt, and so on, the markets are positive so far this year. So if you already have a client, an investor, right, who is worried even when the market is positive, you need to take note of that. So We encourage the audience of this podcast to reevaluate where their portfolio stands, what direction we want to take, and to assess whether we are really positioned where our risk tolerance allows and where we are meeting the goals we have set. And maintain discipline. Discipline is extremely important. The discipline of diversification has been excellent this year, and that's what we're here for. So thank you. If you have any questions or want more information, or if you want to reach out to us, you can contact us.
Absolutely. Well, that's all the time we have. Jose Miguel, we're wrapping up this special edition of the Financial Game. We look forward to seeing you in the next edition next month. Take care.